Right, now we will discuss question number 176 onwards. Right, question number 176. Look at the question. Look at the question. Question number 176. Look at the question. Paper 6. Paper 6, question number 176. Below are some details of a manufacturing company. Monthly demand 1000 units. Monthly demand. Cost per order. Cost per an order 300. Holding cost per an order 80. The economic order quantity and annual ordering cost of the above inventory units are. You need to calculate economic order quantity and then annual ordering cost. Economic order quantity and annual ordering cost. Right. When you're calculating economic order quantity, how to calculate EOQ? EOQ 2DCO divided by CH square root. Okay. Demand for the year, cost per order divided by CH and square root. Then here, in this question, monthly demand 1000 units. Then annual demand how much? Annual demand 12,000. Annual demand 12,000. Cost per order 300. Cost per order 300 divided by holding cost per an order. Normally it should be holding cost per unit. Okay, it should be holding cost per unit. Here, holding cost per an order. Holding cost per an order. Holding cost per an order. Actually, it should be holding cost per unit. Holding cost per unit. Normally in the examiner will provide you holding cost per unit, or sometimes he will give you selling price or something, and then using the selling price or something you need to calculate. Okay, they will provide you a ratio to get the holding cost per unit. Yeah, I think this is some kind of printing mistake. Okay, then it should be holding cost per unit. Holding cost per unit. Here 80 into square root. Into square root. Then students, 2 into 12,000 into 300 divided by 80 and then square root. Square root 300. Economic order quantity 300. Economic order quantity 300. And then here you need to calculate annual ordering cost. Annual ordering cost. Insurance, economic order quantity 300. Annual demand how much? Okay, here total annual demand 12,000 quantity. Annual demand 12,000 units. Then annual demand divided by 300 per order. Okay, economic order quantity 300. If economic order quantity 300, total orders, number of orders that the business organization need to place for the year is 12,000 divided by 300. Number of orders 40. They need to place 40 orders for the year. 40 orders for the year, and then 40 orders into cost per an order 300. Cost per an order 300. Then total ordering cost how much? Total ordering cost 12,000. Total ordering cost 12,000. Then students 312,000. Yes. A fifth one is answer. Answer is a fifth one. Answer is a fifth one. Okay, economic order quantity 300. Annual ordering cost 12,000. Fifth one is answer. Fifth one is answer. Right. Now we look at question number 27. Look at the question number 27. Right. Students, what is the answer for the question number 27? Look at the question number 27. Try to get the answer. Sorry, 177, na? 177. Right. What's the answer for the 177? Right. Look at this one here. The average hourly wage rate of a production worker in the garment manufacturing company is 200. Average wage rate is 200 rupees. And the overtime wage rate is 250 per hour. Overtime wage rate is 250 per hour. Okay. Premium paid to employee. Okay. The premium paid to employee for an hour is 50 rupees. 50 rupees. Premium is 50. That premium you need to transfer to overhead cost. In overtime, the business pay premium 50 rupees premium to the employee. Then that premium you need to transfer to overhead cost. You can't recognize that premium to direct cost. Monthly gross salary of one production worker in the company is given as follows, right? Basic salary 200 for 160 hours, 32,000, right? 32,000. Overtime payment 10 hours, 250 into 250, 2,500. Incentive overtime allowances 100 units at 20 rupees, 2,000. Gross salary 36,500. Gross salary 36,500. The value of the salary to be recognized as direct wages in prime cost. Prime cost. Value of the wages to be recognized as direct wages. Direct wages. How much the direct wages? How much here in this question? Basic salary 200 into 160 hours, 32,000. Basic salary we can take on into prime cost. Overtime, in overtime, 10 hours overtime, 10 hours. 10 hours overtime, overtime rate is 250. Then when you recognizing overtime expenses to direct cost, this premium, 50 premium you need to remove. Normal wage rate is 200. Okay, then this additional 50 rupees you need to remove. Then, okay, then you need to pay, you need to consider 200 rupees overtime payment to direct cost. 200 rupees. Then premium payment you need to charge to overhead cost. Premium payment you need to charge to overhead cost. Then students 10 into 200. Normal wage rate is 200. Then 10 into 200, 2,000. 2,000. And then here, incentive overtime allowances, 100 units. They pay incentive. They pay incentive per unit. They pay incentive per unit, not based on profit. If they pay incentive based on profit, then that payment of incentive you need to charge to administration expense in the profit and loss statement. But here they pay overtime based on units. Then 100 into 100 units into 20. 2,000. 2,000. Then salary should be recognized as direct wages. How much? 36%. 36%. Then answer is what? Question number 177. Question number 177. Answer is second one. Second one is answer. Second one is answer. Answer the second one. Right. Now I look at the next question. Question 170. Try to get the answer for the 178. Right. Look at the question. Try to get the answer. The prime cost of producing 1 unit of M in a manufacturing business is 350. Prime cost 350. The time spent by each production department in producing M and overhead cost absorption rate of each production department are shown below. Production section ABC, labor hours spent 10, 4, 6, machine hours 12, 5, 3. Overhead absorption rate 20 per labor hour, B 10 per machine hour, C 12 per labor hour. They have given. Okay, overhead absorption method they have given. In production department A, 20 per labor hour. In production department B, 10 per machine hour. In production department C, 12 per labor hour. Right, simple, easy question. The unit production cost of this product is unit production cost. Simple question. Right, then here, prime cost how much? Prime cost of the business organization is how much? 350 prime cost. Then overhead cost. Overhead cost. Department A absorbs production overhead cost based on labor hour. 20 per hour, labor hours spent 10. Yes, labor hours spent 10. Spent by the production department in producing M. Right. Labor hours 10. 10 in then 20 to 10. Production department B, 10 per machine hours. 10 rupees per machine hours. Machine hours 5. Machine hours 5. Production department C, 12 labor hours 6. Then you can calculate the overhead cost. You can calculate the overhead cost. How much? 20 into 10, 200. 10 into 5, 50. 12 into 6, 72. Right. Total production cost 350 plus 200 plus 50 plus 72. 672. Right. Total production cost 672. 672. Right. In this question, there is no answer. Right. In this question, prime cost 350, and then overhead cost production department A 200, B 50, C 72. Total production cost is 672. There is no answer. Yeah, answer should be 672. 672. It should be the answer. There is no answer. Write down 672. 672. Right. Look at the question number 179. Lamai, try to get the answer for this question. 179. Get the answer. Get the answer. Right. Here, fixed cost of a business is 30,000. And the contribution to sales ratio 40%. If total variable cost is 60,000, what is the net profit of the business? You need to calculate the net profit of the business organization. What is the net profit of the business? Right. In this business, total fixed cost 30,000. In this business, students, total fixed cost 30,000. Fixed cost 30,000. Fixed cost 30,000. And then CS ratio 40%. And variable cost 60%. 60,000 variable cost. Variable cost 60,000. Now, if variable cost 60,000, total contribution how much? Total contribution, if CS ratio 40%, contribution to sales ratio 40%, variable cost how much? If contribution 0.4, variable cost how much? Variable cost 0.6. Variable cost 0.6. Then divide variable cost by equal amount 0.6 multiplied by 0.4 to calculate the total contribution. And from the total contribution, you can deduct total fixed cost. 60,000 divided by 0.6, 100,000 into 0.4, 40,000. 40,000. 40,000 total contribution. total contribution minus fixed cost of the business. Fixed cost how much? 30,000. Then profit of the business is how much? 10,000. Profit of the business is how much? 10,000. Answer for the question number 179. Question number 179 is yes. Third one. Third one is answer. Third one is answer. Okay. Net profit of the business how much? 10,000. 10,000 is the net profit. Right. Okay. This question belongs to chapter 15. 15. Cost volume profit analysis or marginal costing. Right. Look at the question number 180. Get the answer. This question belongs to last chapter. Investment decision. Chapter 16. Chapter 16. I think you may have covered syllabus in my classes. 2 months ago, I have covered syllabus. Therefore, okay, students in my classes can get the answer for this question. Huh? Right. Others, if you have covered, then you can get the answer. Right. Now, I look at the question. Of the project is 500,000. Net present value of the project is 500,000. When the other factors being constant, which of the following factors affect to decrease the net present value of this project? Net present value, NPV, net present value. Factors affecting to decrease the net present value of the project. Question number 180. Question number 180. Question number 180. Right. Here, factors affected to decrease the net present value. Decrease in the discounting factor. No, if discounting factor decrease, NPV will increase. Net present value will increase. Therefore, we can't accept first one. We can't accept. Second one, increasing initial investment. Yes, if initial investment is higher, then net present value will decrease. That is correct. B, we can accept B. C, decreasing net operating cash flows. Decreasing net operating cash flow. Here, decreasing net operating cash flows. Now, net operating cash flow, decrease in net operating cash flows. If net operating cash inflows or outflows, okay, we will adjust it as decreasing net operating cash inflow. Okay, operating cash inflow or outflow. Okay, I think there's some printing mistake here also. It should be decreasing net operating cash inflow. Okay, correct is okay, adjust it as decreasing net operating cash inflow. If net operating cash if net operating cash flow if net operating cash inflow getting decreased, what will happen? Net present value will decrease. Please adjust it as decreasing net operating cash inflow. Okay, here the factors affected to decrease net present value. D, increasing the cost of the preparation of the project report. Now, sunk cost. Project report will not impact to the project. Okay, to evaluate the project. Here, answer should be B and C. B and C. B and C only. Here, please adjust C. Decreasing net operating cash inflow. Inflow. Right. Right. Then answer should be B and C. B and C. Factors affected to decrease in net present value. Right. Right. And then please complete question number 181 also. I will give you another recording for the for another 5 or 10 questions.